Hey guys, for anyone who's not started investing yet, we want to open today by telling you how transformational investing for just a few short years can be. While this video is asking whether I should now stop investing a few years in, we really want it to be inspiration for people not yet sure of whether they should start, or who have only recently started and need to know where this journey is heading. My money thoughts are no longer occupied with changing jobs, chasing promotions, or asking the boss for inflationary pay rises. Having spent the last several years as a committed investor, my money thoughts are now things like getting money out of my investment properties, getting double-digit returns, and retiring early.
Even though we are both a long way away from our target retirement fund sizes of around £1 million, once you've started to build up a decent sized investment pot, you start to have a lot more options than when you had nothing. We're going to look at whether hitting the milestone of 1/3 of your target pot size is good enough to just leave it to its own devices and let compounding grow the pot to its target size.
With the alternative being potentially decades of diverting your disposable income into investments, is it better to divert your focus away from investing at this point and focus on living life to the max instead? Maybe our whole working lives don't need to be about squirreling money away for financial independence. I'm asking today that now that my portfolio has been well established and is growing organically, have I now done enough to stop investing? We'll look at the arguments for stopping, as well as those for why investors might want to stay the course. Let's check it out.
First off, we want to thank investment app Orca who are sponsoring this video. Orca are giving away not one, not two, but 3 free stocks, each worth up to £200 to everyone who signs up and places their first trade via our offer link, linked to in the video description below.
The app has advanced analytics like this chart showing performance versus an index. You can read up on all the latest news within the app, and you can place postponed orders when the market is closed. And one feature that is super cool is Smart Stop. This allows you to set a stop loss that trails the price automatically, helping you to lock in profits.
Orca have also just released additional features if you sign up to their premium plan, what they call Smart Hunt. These include a heavily discounted FX fee, advanced analytics including income statements and cash flow, advanced filters to find stocks, and more. There's currently a 30-day free trial so you can try before you upgrade. Now let's get back to the video.
How has life changed since I started investing? I started investing properly exactly 5 years ago, with my first major action being to put about 20 grand into a joint property investment with a mate. That property has since gone from £105,000 to £170,000 and pays £800 rent a month.
If you're just starting out, you probably just think about your job income when you think about your finances. But when your portfolio gets into the 6 figures, it starts to take on a presence of its own. Securing a pay rise from your job doesn't matter so much when every few years you can extract 20 or 30 grand of capital gains from a property on a remortgage, or when dividends from your stocks and shares ISA could be used to finance the reduction of your work hours to a 4-day week, or to pursue a career in a passion that pays less.
Now, my total portfolio stands at £300,000, 1/3 of the way to my target retirement goal of £900,000, and compounding is finally starting to be a powerful influence. If the portfolio grows by 10% a year from capital growth alone, a reasonable assumption given so many of my assets are leveraged, that's £2.5 grand of growth a month on average before I've even added anything from the day job. I'm 33, just an ordinary guy from a working class background, and I only started 5 years ago. And now I could feasibly stop worrying about investing altogether. And the takeaway point should be this: you could do this too, and you could do it even faster than I did.
Coast Fire, the fun way to financial independence. What we're describing when we talk about stopping investing is Coast Fire. FIRE, of course, is shorthand for financial independence, retire early, and you get to FIRE when the value of your investments reaches a size that is large enough to pay you a lifestyle supporting income. Coast Fire means that you get to your target investment pot size by just coasting along through your career without worry and spending your disposable income as you choose each month rather than investing it just like everyone else in the country does, though they put their future down to wishful thinking.
The difference between this life plan and that of a normal person's is that you would first spend a few years building up a relatively small investment pot when you were young, that you can then leave to compound its way to glory while you go live your life.
You can declare yourself coast fire when your compounding pot is on track to be big enough in order for you to stop working and retire at an age of your choosing. That retirement age could be any number less than the state pension age. Temporary setbacks don't really matter. We can both be pretty sure that we'll now remain on track for coast fire despite inflation fears, interest rate rises, war and the other scary things on the news. If you're taking a long-term approach, then market swings should be par for the course.
For me, I consider myself to have achieved coast fire because this number has now fallen below age 50, but your number may be higher or lower than this. Still being forced to chase a wage after 50 out of necessity is a thought that chills me to the bone. By investing, I should be able to get there before that. Now that my pot is a third of its target size, the retirement calculator on moneyunshackled.com tells me I'm just 16 years away from full retirement by stopping investing now and following coast fire. Retirement at 49. Continuing to invest each month would let me retire much earlier than this, but if you enjoy what you do, is it worth racing to early retirement? How to get there in just 5 years. I've gone from a dedicated wage slave to achieving coast fire in such a short time due to a willingness to take a higher risk approach to investing by leveraging my assets with debt, or in English, I bought investment properties with mortgages. I occasionally get to reinvest big chunks of the capital growth that can be released when you remortgage, on top of the wicked rental profits. My plans for this year include extracting 45 to 50 grand of unproductive capital from my properties to get that working for me at 20% plus annual returns over the next few decades by either buying another rental or leveraging it in the stock market. When invested, this could improve my monthly average investment gains by another grand.
For more information on the strategy behind this investment style, be sure to watch this next video. And if you're interested in investing in buy-to-let properties yourself in this way, check out our Find Me a Property service on moneyunshackled.com, where we'll put you in touch with our approved property agent who'll help you get set up with your first high-returning buy-to-let property, or even source you a whole portfolio of them.
Why you should keep investing. Surely we all dream from time to time how it might be if we stopped trying to save money each month and spent it all instead on doodads and experiences. But for anyone else out there seriously considering doing so, there are some very powerful reasons to keep going.
Number 1, assets will never be cheaper. Right now is likely the only opportunity you'll have to buy assets at today's prices. Since markets over the long term always climb relentlessly upwards, in 20 years or so the prices of stocks, property and everything else will most likely resemble nothing like the prices available today.
Just 10 years ago, in April 2012, the S&P 500 was priced at under 1400. At time of filming, it's above 4,500, a 228% price hike. Can you, in good conscience, forego the opportunity of buying assets now when, upon reflection in just 10 years' time, it may look like the market was practically giving them away?
Number 2, new money lowers your risk. Regular monthly investing acts as a kind of counterweight to drops in the market value of your portfolio, since you are constantly adding fresh money. Traditionally, investments in bonds have been relied on to help reduce overall volatility and smooth a portfolio's ride.
Some gurus, including the authors of the book Life Cycle Investing, equate the regular contributions to a portfolio from earnings from a job to holding bonds, to the extent that if you have one, you don't need the other. The power of having an external source of income that drips fresh money into a portfolio over the long term means you can focus purely on owning productive assets, such as stocks and property, and worry less about the ups and downs of the market.
Number 3, get to fire quicker. Instead of taking, say, 16 years to coast your way to fire with a small pot, the same person might get to fire in 10 or fewer years by continuing to work and adding to their portfolio. Because most of the legwork is done by compounding in the end stages, it might seem like continuing to contribute to your portfolio isn't worth it, since it only knocks a few extra years off your retirement date.
But it's easy to say the words, only a few extra years. Quite different to live through them whilst glued to your office desk. We'd say that every year counts. No one saving for retirement should ever dismiss the opportunity to save even a few extra years from a grasp of wage dependency.
Number 4, an early crash can set you back years. If you stop investing and place your hope in your portfolio growing through compounding alone, it matters a great deal what happens in the first few years. A market downturn soon after you've stopped contributing could significantly lower your portfolio without you benefiting from any of the buying opportunities that a crash presents.
Number 5, tax efficient and a higher salary. If your retirement investments are in a pension, then it makes sense from a tax perspective to keep putting as much into it as you can, especially if you don't mind waiting until you're in your 50s to be able to access that money. If your employer is also matching your contributions, then the 100% immediate return on this investment is perhaps too good to ignore.
Is it time to start living rich? If you're investing hundreds a month, what could you be spending that money on instead? Big car, fancy holidays, a bigger home, and bigger mortgage? Do we really need any of this though? Not really. The thing we value above anything else is time, and whilst in the portfolio accumulation phase, our time can never truly be our own since we'll be forced to work for money, coast fire or not.
As every penny invested gets me closer to freedom, I'm going to keep investing for as long as I can be bothered to keep working full time, safe in the knowledge that due to my existing investments, I have got options if working quite so hard ever becomes a chore.
Question of the day, will you keep investing right up to retirement, or in what circumstances would you stop? Join the conversation in the comments below. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.